All right, well, let's begin. Thank you all for your time today. What we're going to do is we're going to have a look at self-employed income and the recent addition that we made from the point of view of actually providing detailed tables for fixed expenses and variable expenses. And I want to talk about one thought first. Where we can put in gross income, why not just look at what the net income is? You know, why not take whatever the revenues are less the different expenses, just look at the net and throw it in. And one of the problems with that, I think, is that if somebody wants to consider semi-retirement, where let's say their gross income, we'll just say, drops in half, variable expenses are expenses that are really directly related to gross income. So if we go down and have a look at the details table, you know, the cost of goods or supplies. Well, if I'm earning half as much, I'm going to, or my sales are half as much, I'm going to assume that my expenses are probably half as much. My cost of goods or supplies is half as much. The problem is, of course, that fixed expenses, such as rental, real estate costs, or office costs, telephone communications, that sort of thing, they're not going to drop in half. You know, rent is still going to be rent. So if we summarize net and use that in gross, but then somebody turns around and says, what about semi-retirement? What we're able to then show is that the profit margin, so to speak, in semi-retirement might be very, very narrow, and really, is it worthwhile? So I think it's in that case, it's a good idea to use the fixed and variable expenses. So we used to talk about, you know, looking at the income and in the case of a corporation, for example, the income statement, and eyeballing and deciding, you know, what's fixed or what's variable. Or in the case of, this is an actual file that one of our clients sent in, and we got rid of all the particular names and everything. But you can see here, you know, cost of goods. And then when we drop down in here, we can see all the different expenses: advertising, meal, entertainment, et cetera, et cetera. So, you know, we would talk about eyeballing these and saying, well, what's variable? Well, advertising is variable. What's fixed? Commercial insurance is fixed. You know, office expenses would be fixed. We always have to pay those. So what we did, just to make life a lot easier for people, was we added the details. So now we can go in and we can look at variable expenses, open up details, and you can see cost of goods supplies is line 8320. So if we switch back over here and go down, you can see right here that line 8320 is 133. So all we need to do with VisionWorks is just, you know, type in the $133,000. And then as we go down and have a look at other expenses such as advertising, it's 730. So again, we can come back over here and go to advertising and type in 730. So what you'll find with self-employed income, sorry, somebody is got their microphone on. If you would please mute, we're getting a little feedback. Sorry, let me go back here. What you'll find with the individual tax return is that what's filed with it is a T2125, which is for business or professional income, a T2042, which is farming, and a T2021, which is fishing. So if you look, this is actually the Form 2125. So all you've got to do is, you know, get a hold of the tax return and then go to the correct form and then just work your way down, and you will see all the different expenses with all the line numbers. and then you'll be able to get those accurately entered, and you'll just have to bounce back and forth between the expenses that we've put in that are variable expenses and then expenses that we've put in that are fixed expenses. What I thought I'd do does anybody have any questions about this? I think you'll find that it's fairly straightforward. There is a category here, by the way. I haven't put in details for the fixed expenses, but it's just picking everything up and putting it in under other. But what you are able to do, of course, is click on other, and if something isn't listed, you can actually type in what it might be and then put that in. We didn't go overboard, by the way, on the farm expenses. You'll see line upon line upon line of seeds and fertilizer, et cetera. It just goes on and on and on. So we didn't want to get a little too detailed on that. So you can throw everything in under other, or put it in under, it would be a variable expense actually. Just add those all up and put it in as cost of supplies. So any questions about this? And then I'll flip over to CorpWorks. It's a little bit different. Is it straightforward enough for everyone? Okay, so let's have a look at CorpWorks. And it's different in the sense that we don't have, with the trust, we have those forms, the T2125, et cetera. The trust forms are the same forms as are used personally. But with a corporation, it's a little bit different. What we have in the corporation, if we have a look at income, is that we're not looking at the T2125, for example. What we need to do is we need to look at the Schedule 125. And again, it has all the different line numbers in it. When you get that T2 from the client in the income statement, then one of the things that you want to ask for is that portion of the return that's got the GIFY 125. But if you go down here, just to show you what I mean, we'll go to worksheet mode and we'll go to details. You can see here that what the software is doing is it is populating the GIFY 125. So you can see all the different line numbers here. And this is essentially what you need to get from the client to use those same detailed tables, is the T2 with the GIFY 125, so that you can see the different line numbers and the amounts that go in. But it's just a slight variation on the same theme, so to speak. Any questions from the corporate point of view? So why don't we have a look at this whole issue of COVID, and I'd really like to throw it open for a conversation. I've got a solution in here, which I call COVID. So I'm going to kind of flip over to it, and then I'm going to reset everything. So we'll go in and I'll just get rid of all of these different entries that I put in under tax, other, accrued. I'm going to get rid of this, and just we'll walk through everything. So pre-COVID, Bill's employment income was $120,000 a year. And along comes COVID. All of a sudden, after the first 3 months of the year, income is evaporated, or it's being substantially reduced. So keep in mind that what we are doing with ongoing entries, such as salary that goes on year in and year out, or vacation expense that goes on year in and year out, is the first year of the plan we're always prorating based on the month of the year. So if we go to net cash, for Bill and have a look at his career income, what you'll see is that it's $60,000. We've already passed through the first 6 months of the year. So for the balance of this year, he is expected to earn 60,000. Well, of course, what's happened is that's really changed quite dramatically. But from the point of view of calculating taxes, let's assume in the first 3 months of the year that in fact he did receive, the normal $10,000 a month salary. So what we're able to do then is, first of all, we want to say, okay, well, going forward, we're going to remove the salary from this year. We'll just assume that it's something else. It's government benefits or something. And then we can even go into next year and say, well, during recovery, are we really going to go back to that full $120,000 salary? Or we can put in something which is, a partial amount for 2021, and then assume by 2022 we're back to the full salary, or anything that's in between. It's up to you to try and sort of, put in something that's reasonable. So we've gotten rid of the salary this year, but what we need to do is we need to account for the full salary, let's say the first 3 months of the year, $30,000. So this feature under tax, other, accrued. What did we earn earlier in the year? So this is where we can go in and say, earlier in the year, we earned $30,000 the first 3 months. And then we could put in something like other income. Let's say we had 3 months of whatever it is, $2,000 a month, which is $6,000. Government benefit or something like that. In this table, I just want you to be aware of it in the sense that somebody, again, makes charitable donations, and that is prorated, based on the month of the year. But maybe somebody made some large donation earlier in the year. We need to account for that for taxes, but we can't use any of the buttons, any of the graphs to enter it, because from a cash flow point of view, it's already happened. It's history. So we have to enter something that, what happened previously. So we're able to use the accrued buttons to account for that sort of thing. So what I want to do now, though, is I want to say, well, on a go forward basis, what's the income look like? So what I can do now is go to career. Let's just see, I've got 2 accrueds in here. Let me get rid of that one. I can go to career, and I can go to other, and I'll use other income. And again, I'll just make this, government benefits. So what am I going to receive for the balance of the year? I know these numbers aren't accurate, but it's just to illustrate the point. So let's assume that for the balance of the year, I'm going to get $2,000 a year for the next 6 months, or $2,000 a month for the next 6 months, $12,000. So I can account for that on a go forward basis. So now when I look at net cash from a career point of view, what I've got is the career income that I expect to receive in the balance of the year. And then when I go to uses and I have a look at income taxes, now I can see there's my employment income for earlier in the year. That was the accrued entry. And now I've got a $12,000, or I've got a $6,000 that I put in as other income from earlier in the year, the government benefit that I received. And now I've got the employment income for the balance of the year. So that's how we're able to manage to get in all the right entries from a tax point of view, but also account for just the cash flow as being, something that's left to us. Now, the reason I wanted to use this is because if we look at net cash flow, what may happen is we may see that, we're going to be drawing down on portfolios, et cetera, to make up any difference. We may have to go in, obviously, and think about changing our lifestyle, especially our latte factor spending. But one of the issues that people have is this ability to have some long-term perspective. And so if we're not making our full $120,000 for all of 2020 and all of 2021, you know, we could have a major disaster, et cetera. So what we're able to do is we're able to have a solution, the status quo, go in, create a solution, and enter the changes. As a matter of fact, what I'll just do is I'll copy this just so we can do a comparison. And I'll just call this no changes. And then what I'll do is I will get rid of that other employment income. I'll get rid of the accrued income, and I'll restore Bill's career income. Where did it go? Sorry, I will restore Bill's career income to the $120,000 a year. So this is had nothing happened. And now under the new, the new circumstances. And now if I go to the compare tab, I can compare the impact of COVID and the impact of had things not happened. And we can look at total income assets for the family and see the difference. And when we do, you can see that the peak year is $1.3 million. The peak year here is a little bit more, $1.5 million. We are running down our assets. You know, we haven't accumulated as much, so we're running them down, but we're able to give people a little bit more of a perspective. And this might be the case where we go in and we look at net cash and possibly adjust some of the spending, especially our latte factor spending, to get it under more control. So I think we're able to some degree, allay people's fears, give them some longer perspective, and then also have a conversation with them about you know, their latte factor spending and values-based lifestyle trade-offs. In other words, if we spend less on the latte factor and make sure that we're spending money on just those things that are truly meaningful to us, then probably, you know, we're going to be able to survive all of this without major issues. So I think we can be really supportive of clients if we talk with them and give them this perspective. So why don't we throw things open for conversation and entertain any questions. Anyone? Always takes a while for somebody to warm up. Anyone with a question? I'm just going to get rid of some latte factor spending here. Sorry, somebody have a question? So we can see, you know, reducing some latte factor spending, what the impact is. And it's very close to what we started off with. A little less at the peak, obviously, but I also eliminated $10,000 a year of general expenses. My personal experience in doing support calls is that clients with family income around $150,000 have, I'm going to generalize, on average have $24,000 a year, $2,000 a month after tax latte factor spending. And as soon as you get up into the $200,000 level, it's more like $2,500 a month, $30,000 a year that on average is unaccounted for. So for people to have a look at that latte factor and cut it back by $1,000 a month, I don't think they'll be giving up anything that's in the least important to them. So yes, a big disruption of income in the next year or two. But if we're a little more prudent on our expenses, and I think a lot of people have cut out restaurants for obvious reasons, then they'll get through it without any significant issues. So questions, please. Anyone? You need to unmute to ask a question.
I'll throw this out, Michael.
Good.
And that's really those scenarios where, let's say, people are choosing to defer payments. So it's not saving them any interest. Anything in particular you think that we should model in here?
You mean deferring mortgage payments and things like that?
Yeah, I guess, or loan payments, any of that kind of stuff. But yeah, I guess, or loan payments, any of that kind.
Well, deferring, I think, is just pushing everything out into the future, isn't it?
Yeah, but you're accruing interest in the meantime because you're not making those payments. And just remind me, VisionWorks actually takes that into consideration?
I'm not sure if we have attended to that, actually. We've assumed the continuation of payments. It's actually something I hadn't thought of. So we would be deferring the payments and pushing it out more into the future, which would be extending the term or the amortization. I have to think about that. That's a good question. I actually hadn't thought about it. Yeah, let me chew on that one. See what we can do. Anyone else with any questions? The whole self-employed business or the business in CorpWorks and the addition of the the details panels, just so that it's now very straightforward, or the whole COVID conversation with clients.
Yeah. Hey, Michael, it's Alan.
Yes, Alan.
Just, is there anything that we should be aware of on the businesses with capital cost allowance and stuff like that, and entering that information?
In what sense?
Well, I don't know. I just didn't know if there's anything that we should be aware of, or if you have any tips when entering.
Well, are you referring now to the
like depreciation on things?
Yeah. So if we have a look at this, I'm not sure if there is a depreciation charge here anywhere. Yeah, here it is, here. So what you'll see with the income statement for a corporation is you will see an amortization charge. What we do is we do that internally to the particular asset. So let me go back here to self-employed. So you ignore the depreciation charge that you'll see on the T2125 or whatever. Here, if I go to Bill's career, and I'm just going to throw in whatever other property might be, and I'm going to put in a value of $100,000. Let's just pick a number. And also put in the current UCC of $100,000, and let's make the purchase price $100,000. So what ends up happening then is that you assign a class. So let's just say it's a class 8 property, 20% per year. And if you click help and look at property classes, you'll get a list of all of those things that fall into the different classes. So you can go down and see what qualifies. So what happens then is if we go to net cash and we have a look, we drill into cash sources. Wait a second. Wait a minute. What's going on here? Oh, maybe I gross income, fixed, variable. Oh, sorry, my variable expenses are huge. We're not making any money. So now if we drill in to the career income, what you'll see in the table is that the CCA claim is actually being used in this table to come up with the taxable self-employed income. So we do this because you could have, instead of a single line of amortization, let's say because you own a bunch of rental properties, we would attach the amortization to each individual rental property. So in the forms that would be for rental properties or self-employed business where you've got, equipment or something that you're depreciating, we do that within the thing itself. So you just ignore the amortization charge in, let's say, the 2121, because it's actually done through the property itself. And then the reason we do this is because amortization is going to change from year to year. Maybe you're going to go out in the future and add more of a specific type of property. So all of that's going to be accounted for. Does that answer your question, Ellen?
Yep. No, that's good. So actually, I discovered something the other day too. I've got a client they're selling their house to their daughter, but they're going to live in the house. So they're going to give her 50% ownership.
Right.
Anyway, I figured out how to do that on VisionWorks the other day. I don't know if you want to. That's
yeah. Well, you can go in to the ownership, and you can add somebody as an owner in the table.
Yeah, but I did it through the lifetime, which was neat.
Sorry, through the.
So I opened up the lifetime tab down below because they're going to sell
over time tab. Yeah, so you can go in at some point in the future and yes, absolutely, change the ownership interest in the future. Yeah. I guess I don't actually. No, maybe I do. Oh, there we go. So I can make it, Bill Jr. now 50 and Bill and Sue 25 out at some point in the future. Absolutely.
Yeah, that worked well.
Yeah. Anybody with any other questions? Okay, well, I hope that you got some value. I thought the new feature was important to introduce, but I also thought that talking about COVID might be useful. I think a lot of advisors are hesitant to be doing any planning in the circumstance, but I think a lot of it is you can do some very worthwhile hand-holding. Remember when I talk about the 3 C's and 5 planning themes, one of those planning themes is, if we go down through house rich, cash poor, large latte factor, one of the themes is net cash. And the example I usually use is, we've got a few years in here where we've got extra expenses for a child's education and we're running cash flow negative, and maybe we're running up a line of credit or something like that to educate the children. And all clients see, because they're living in the moment, is we're spending a lot more money than is coming in, and we're very worried about it because they lack the long-term perspective. And then once they get past that period of the child's education, everything straightens itself out again, and it's all fine. And I think that the COVID theme, in many respects, falls into the same concept. You know, in the immediate present, we have all these concerns because we lack perspective. So you can go in, you know, make some adjustments that are, you know, conservative on a go forward basis for income. And then for obvious reasons, also adjust latte factor spending and show clients that, you know, in the long haul, the things that are most important to them are probably still going to be more than doable. Anyone else? Okay, well, thank you for your time. And if you have any questions, please let me know. And otherwise, I hope you have a great weekend. Thanks.